So let's start. Good afternoon to our esteemed investors and partners. My name is Nimesh Mehta, and on behalf of ASK Investment Managers family, I welcome you to this 7th quarterly webinar, Mr. Bharat Shah, Executive Director, ASK Group. We generally schedule this webinar in the first or max second week of the month post the quarter end, but we intentionally delayed it to today post budget, which happened yesterday, so that we can hear Bharat Bhai's views on budget. And a lot of people have requested me separately about hearing what Bharat Bhai thinks about the current budget and obviously its impact on our portfolios. So today's 1 to 1.5 hours, which will focus on two pieces. In the first 20 minutes, we'll request Bharat Bhai to share his thoughts on the budget, and obviously he can help us connect and understand with impact on our portfolios, our sectoral holdings which we have. Second, in the approx 10 minutes later, what we have, last time we heard Bharat Bhai was on 6th April 2024, and the results actually came in much later. So we would request him to talk about how has been the overall FY24 results, and in particularly Q4 FY24 results. And the clients would want to know what is your thought on the results expectation from Q1 FY25 and maybe the FY25 whole. So I will stop it there and let Bharat.
Will you just allow me half a minute? If you can continue for half a minute, there is something.
Sure. So no worries. So and the next 30 odd minutes to 40 minutes, what we will do, request all the partners, clients to keep typing their questions. What I will try to do is curate for you if it is not answered in this presentation. That's where I think, so keep typing your questions. Don't wait for the session to get over, and I will ask in between or towards the end to Bharat Bhai. So we'll just... Is that okay, Bharat Bhai, to start?
Okay. Yeah, just half a minute if you can give me.
Sure. So, investors, you all can keep starting. So there is no presentation. I think Mayank has requested the presentation. There is no question. Good afternoon to all. All those who joined a little later, this is our quarterly webinar with Mr. Bharat Shah, Executive Director of ASK Group. And today, all of us are waiting to hear his thoughts, Bharat Bhai's thought on the budget that happened yesterday. What's the impact on our portfolio? What's his thoughts on FY25 earnings? I think he's ready. So over to you, Bharat Bhai. Thanks for your time.
Apologies for that 1 minute lag. Something urgent cropped up which I had to deal with. Well, if I have to make a few comments about this budget, and I have to link it to budgetary exercise of this government over the last few years, to my mind, 4 or 5 key points emerge. Number one, this government has displayed a very clear prioritization of capital expenditure over the revenue expenditure. Traditionally, if you see, what has been the picture in our budgetary exercise, all along it has been heavily loaded in favor of revenue at the expense of capital expenditure. We all know that capital expenditure builds assets. Assets build future revenue and income and profits, and therefore capital expenditure becomes a self-sustaining, value-creating expenditure over a period of time, provided it is used for assets which are productive. Revenue expenditure typically is more in the nature of shorter-term gratification or dealing with things which are really emanating from the financial structure of the government, like interest cost and others. And that doesn't lead to any capital formation, and therefore it doesn't lead to long-term value creation. This government is very, very clearly shown over last 6-7 years in general, and last 3 to 4 years in particular, very sharp and rising focus on the capital expenditure. Second, which is very redeeming feature of this government, is in terms of the control over the fiscal deficit, financial discipline, and I would say fiscal rectitude in terms of the behavior. The best example of that I can give, apart from yesterday's budget, where a lot of people thought that the setback that the government, the ruling party witnessed in the general elections would have impact on the kind of budgetary exercise that they will do. But it is very clearly shown that this government is continued to remain on the path of fiscal rectitude, fiscal consolidation, and financial discipline of the highest order. Even during the COVID time, when the world is basically focused, whole of the world, I would say, America, Europe, China, Japan, in giving freebies and gratification to people, India remained on the path of fiscal discipline. The net effect of all of this is a stable inflationary scenario. But for this, inflation would have run amok and gone out of hand, especially with the two wars still going on in the world somewhere or the other. Also, it would have made rupee go haywire. By remaining fiscally prudent, actually government does a favor to people by reducing inflation. And reducing inflation is in a way a reward offered back to the people by raising their purchasing power. The third factor, if we see in terms of approach to providing social benefits, these are not really social benefits, but really socio-economic benefits. Housing, for example, for which 10 lakh crore is committed for next 5 years. I mean, it's a staggering amount, 10 trillion rupees over next 5 years for the housing for the poor, whether it is providing water, drinking safe water, convenience as well as health, whether gas at home, convenience as well as health again of the women folk, and the things like toilet, which is self-esteem as well as health correlation. All of these social benefits really are socio-economic benefits. They build a better society, more productive society, economically more enabled society, and therefore they become, rather than parasitical dependence on the government dole-outs, they become productive economic agents in the progress of the country. And therefore, I regard the approach to give these social benefits also in a very constructive, well thought through way. Fourth example, in terms of important expenses that people have to meet and what government is doing. The government 4 months back came up with the solar rooftop yojana. Uh, what is the name? Not Sabhagya, but I think Surya Roshni or something like that. It came up with. Basically, government, depending upon the kilowatt of energy being produced, would subsidize putting the equipment for solar system on the rooftop of a household by 33 to 50%. Against that, the rooftop solar system would be put, which would pay for 300 units of energy consumption for individual every month. Apart from that, it will generate excess electricity, which will be supplied to grid. That will fetch revenue to the entity concerned, which in turn will pay off the EMI for the funding taken for that remainder of the cost, which will be paid off over a 3-year period. Instead of giving doles and freebies like Delhi and Punjab and many other states do, it is a very refreshing approach to create actually value creating asset, preserving the pride of the people that they are not dependent upon freebies being thrown by government, but actually become productive economic agent. And last point I will make on the budgetary exercise is the strategic vision. If you see a series of budgets over last 6-7 years, actually actually become a part of a pattern of a strategic vision and strategic priorities of the government. These are well spelled out, reiterated every year, and you can very clearly see that the provisions being made are really in sync with the economic priorities which have been made out. And therefore, truly, in last few years, budgets have become vision and execution documents and phenomena rather than a drab and dull exercise in financial numbers. And therefore, budgets have acquired a very meaningful and productive life of their own in last few years. And therefore, it reflects strategic thought process rather than tactical tinkering with the finances of the country year after year, which is a hugely positive, refreshing change. The effort on infrastructure remains. The amount of money being spent on that at 11.11 trillion rupees has remained unchanged. Effort at Atmanirbharta in critical areas like railways and defense remain, and the spends have been maintained and not altered a wee bit. The spend in building rural infrastructure also has remained, and large amount of some 1.7 trillion has been committed to that area. I already mentioned about 10 trillion being committed to the housing for the poor over the next 5 years. A huge number, which has deep implication on many sectors and industries, because housing is a mother industry, whether it will result in demand for cement, demand for building products, demand for many other services that will go along with the building of those houses, and therefore employment and many of the stuff that goes with it. All of these means that fundamentally the course and the direction of the government and its vision, its actions, they all remain. And therefore, we believe that the path on which this government is very strongly embarked upon in last 5 years in particular remains solidly in place. Therefore, areas like infrastructure, whether roads, whether airports, whether waterways and ports, the transportation hub, logistics, warehousing, whether you talk about capital goods, whether you talk about energy transition systems, energy equipment, energy financials, the digital infrastructure which is being built around various activities which make businesses productive and efficient and more predictable. Many of these businesses that we can see will do wonderfully well. We are also seeing how rapidly railways is transitioning and what are the implications of that. We are also seeing how energy transition systems, greening of energy, will have deep implication on hydrocarbon dependence that India has traditionally got. We are also seeing that how the consumer electronics networks, whether air conditioning, television, mobile phones, are getting reworked, and how India, from a traditional large one-way importer, is suddenly begun to emerge as an exporter in that area. We are also seeing the focus on PLI-led manufacturing area, where thankfully government has remained focused on the 14 key areas that it has charted out, rather than getting all over the place. And therefore, these are the manufacturing areas of strategic importance to the country and aligned to the economic priorities of the nation. And therefore, those businesses also would have a wonderful opportunity for growth. The linked other areas, if you see, for example, electronic manufacturing services and data center growth, artificial intelligence, areas where government is only not only committing resources but driving those businesses. And finally, one of the most refreshing changes that we have seen is a large commitment behind research and development and innovation. Ultimately, when a country builds strong physical infrastructure, really speaking, what will drive the productivity and growth of a country and its GDP, and therefore that of the businesses within the country, will be not really the physical infrastructure, but it will be social infrastructure such as health, education, talent grooming and nurturing, and research and innovation capability. Therefore, government is rightly focused on these areas. We saw first time it emerging 2 years back with a relatively modest amount. Last year, again, the amount increased. And this year, we are seeing that the budget behind that has been 1.8 trillion rupees. And I think it's a step exactly in the right direction to build the future competence and capability. Therefore, I think all of these will lead to strong, sustaining growth. It will result in not only acceleration of growth, but it will make it more sustainable because many parts of the economy are working together and not just a few isolated pockets. Growth becomes synergistic rather than one off, and it becomes geometric rather than arithmetic sum total of the changes being made. And also, it results in improved capital efficiency because all and many parts of the economy keep driving ahead, keep forging ahead. Therefore, I believe, as I have believed for many years now, that India is at the cusp of one of the greatest economic expansions that it has witnessed in India's history. Not only it will be much ahead of India's history, it will be well ahead of any other country of a comparable size or character for a length of time. Therefore, India will continue to be fastest growing economy in the world compared to the other countries as well as compared to India's own past. All of that will occur with the fiscal discipline so that there are no distortions and disruptions which suddenly unannounced come by. And all that will reflect into the growth of the businesses, growth of the entrepreneurs. In turn, it will reflect into the profits of the businesses and cash flows of the businesses. Therefore, the value of the owners of the businesses and the portfolios of the investors who buy into these businesses. And therefore, this budget very clearly affirms, coming right after the election results, which left a sobering note in terms of what will be the economic priorities of the government. But it is very refreshing to see that government has not deviated a wee bit on that. It has continued to remain absolutely on the path of that sustained, long-term, predictable, solid growth of the economy. So that's where I'll stop. And um, um, the second issue, Nimesh, that you raise, how it is linked to our portfolios. Uh, our portfolios already are beginning to reflect these reality. We have raised the quotient on infrastructure investments in the portfolio. We have raised quotient on the manufacturing area. We have raised the quotient on the engineering and the capital goods area. Energy transition systems is another area where we are deeply focused, and we have raised a quotient on that. Specialty manufacturing, again, are areas of huge interest to us. And once again, we've raised weight in those areas. What we have also done in sync with that, we have toned down our exposure to the lending businesses by fairly meaningful margins. We have also toned down our weight into the software services, which have finally come down to a stage where they will be only single digit kind of a long term growth, and that too not always very predictable. And therefore, software services businesses are increasingly becoming businesses more of beta, that is volatility, rather than alpha or value creation. And therefore, we have materially toned down weight over a period of time to the software businesses. Within consumption, our focus is on not the traditional consumer staples, which also India is now successful enough and rich enough that the hair oils of the world and shampoos and soaps of the world are no longer really the darlings of the businesses or greatest of the investment opportunities. But distinguish consumption, discretionary consumption, luxury consumption, consumption of distinguished services, all these remain areas of great interest with the rising economy, with the rising greater success of the economy. These are the areas which will be faster growing and will produce a similar magic that probably decades back or decade back, probably consumer businesses did. And I think that's where the shifting priorities are. Therefore, we have meaningfully toned down weight to the traditional consumer staples, software services, lenders, we have moderated, and we have raised the quotient of weight to many of these businesses. One last area that I'll mention, many of the opportunities which have sprung up that I narrated in infrastructure, in energy, in energy transition systems, or in logistics, or in areas like railways, defense, many of the opportunities which are clearly growing at a much rapid pace compared to the GDP growth. These opportunities relatively are much more in public sector, are relatively less in the private sector, and therefore we have to pick and choose some of those opportunities in the private sector to find a sufficient representation. Indian entrepreneurial portfolio, therefore, has some amount of disadvantage in not being able to participate in public sector units because portfolio primarily invests into the entrepreneurial businesses, and therefore there is some limitation. But we have found some solution to those issues by buying, relatively smaller entrepreneurial businesses into these areas. Given the size of the entrepreneurial portfolio, we are not in a position to be able to buy 3 or 4% weight of the portfolio into some of these names. So therefore, we are adopting a constellation approach where smaller weights of many of these businesses together can give us about 10-12% exposure to some of these additional exposure to some of these areas where we want to participate. So that's the approach we have taken to solve this issue of not being able to participate in the public sector units where a lot of action is going on and where a lot of action is likely to remain for a number of years going ahead, and therefore that cannot be ignored. But otherwise, fundamentally, the portfolio remains rock solid. All our portfolios have done wonderfully well in 2023-24 on purely fundamental underlying performance. The earnings growth of the various portfolios have been between 25 to 32% for the year of 23-24. Underlying top line has grown between 22 to 29%. ROCEs, return on capital employed, very important indicator of the value creation, have ranged from 40 to 50% on an average into the portfolios. Return on equities have ranged from closer to 28% to almost about 35% across our portfolios. And balance sheet wise, all our portfolios typically remain debt equity ratios negative, so therefore very healthy and strong balance sheets, which can conduct and invest into the business strongly and drive the growth ahead. So that is a good indicator of shape of things to come in terms of the underlying returns, which will emanate from the underlying fundamental performance of the businesses where we have made investments.
So, Bharat, you answered a couple of questions on IEP, which people have put, and I'll try to ask them again if it comes up. You mentioned a very important point on the earnings growth, top line, capital efficiency. A lot of people are saying that can we expect the turnaround in quality and growth style of investing? Because, I mean, in the price part, people are writing down that when will the price of the, I know it's a difficult question, but why is the market not appreciating, acknowledging? Because they say your ROCs are superior, your portfolios are very comfortable to us, but when will we see the price and our portfolio performance improve? I know it's a difficult question, but they would like to hear your thoughts.
But it's a very fair question to ask, and therefore I would regard it as not difficult, but a very fair and very appropriate question to be raised. Three things I'll make. One, which is more philosophical, two others, a little more practical. The philosophical point I would make is markets can at times be much more difficult to deal with and can play truant for a period longer than you may like to, or you can afford to. And therefore, markets are not designed to make you happy. Markets are not designed to have a vicarious interest in raising your returns simply because you have allocated capital in the markets. Therefore, markets simply do not regard it as any duty of its own to favor you or to give you any brownie points. Markets say that, look, here I am, and I'll puzzle you, torment you, make it difficult for you. So long as you behave and do the right things, I'll watch it for a length of time and will see to it then if you remain on the right path, then I'll do what I need to do. But if you misbehave and if you slip up, then I know how to take revenge and extract that revenge upon you. That is more philosophical point, broadly to suggest that markets may do things which at times may be out of the window or the compass of what may be the long-term reality, but at a point of time it can still leave you puzzled and tormented and difficult one. Like we are facing the challenge in mainly the portfolio, like Indian entrepreneurial portfolio, not because there is any inherently structural fault in the portfolio. Portfolio, as I mentioned, remains outstandingly strong, but there are areas where markets are deriving greater comfort, where money is shifting, prices are moving up, but unfortunately, Indian entrepreneurial portfolio has limited opportunities in that space because there are not too many entrepreneurial businesses in that space where heavy duty domination is by public sector units and where maximum amount of growth is going on. Therefore, our other portfolios are benefiting from that advantage. And therefore, we are seeing differential results in those portfolios. For example, in April to June quarter, if you look at our conviction portfolio, benchmark index is gone up 8%, portfolio is up about 19%. And therefore, it is ahead of the benchmark by 11%. If we look at our domestic resurgence portfolio, compared to benchmark index of 11.5 in April to June, the portfolio has delivered 16% returns, 4.5% higher than the benchmarks. If you look at our newly minted portfolio, Lighthouse, which has been launched about 4 months back, the index in that particular period is done about 11%, and the portfolio is delivered 24% with an alpha of almost 13% in that particular period. IP, on the other hand, with the same 11% benchmark, has a return of 9%, a little over 9%. So it suffered a drag of 2%. This is despite the fact, if you were to neutralize in index, the PSU part of the index, then IP portfolio actually would have a 2.5% alpha over the index rather than a drag. But unfortunately, it is visible as a drag because it is not able to participate in some of the businesses. But I do not want to sound as if, and therefore, IP will remain a victim of this situation. Actually, the IP portfolio now has become, from a value perspective, very attractive. The businesses underlying are continuing to do very strongly. I described the kind of numbers that the last year our portfolios have posted on the actual businesses. IP has done even better than our average growth rate of top line, bottom line, and even on capital efficiency compared to our other portfolios. Therefore, portfolio is designed to deliver superior outcomes like it has delivered over 15 and a half years with 18.5% compounded average return per annum, with an alpha of almost about 4.5% per annum over 15 and a half years. But it is this particular period where the rise of the PSUs has made little bit challenge on the relative performance. But I think usually, like the cliche says, it is at times a little dark before the dawn, or probably the darkest before the dawn. I don't know where we are. I don't want to make a forecast about it. All I can say is the portfolio is designed to deliver, and markets, again coming back to the philosophical point, markets, while in the short term, are not designed to gladden your heart and designed to reward you simply because you participate in the markets. But at the same time, over the long run, there is no clinically more sanitized place and rational place than Mr. Market. Mr. Market over long run is an extremely efficient and rational entity. And therefore, if the underlying growth rates are sound, underlying quality of the businesses is sound, the growth is durable and predictable and solid, and you're bought into the businesses at sensible prices with a margin of safety at a discount to what they deserve as a value, invariably that character of the investments has to translate into market outcome and the returns. Therefore, while it may look like a challenge today, actually, IP, in my opinion, is a great opportunity going forward, simply for the reason that it has suffered in these 2 years in a relative comparison. In a relative comparison, it is suffering simply because it cannot participate into the parts of the market where it wants to. And I mentioned to you the kind of surrogate route we have adopted to buy a constellation of a few names with smaller position befitting the size of IP portfolio, so that we can find a representation to some of those attractive and important spaces. But given the relative undervaluation of IP portfolio, actually, while it may look like disappointment today, actually is a source of opportunity going ahead. because the fundamentals are intact and valuation is in favor. When you get the two factors together, usually outcomes are very gratifying, but they don't necessarily announce themselves in advance. We have to patiently wait. I know that many of you might have patiently waited, but I can only, if at all there is any consolation or any satisfaction, my own significant chunk of money is in Indian entrepreneurial portfolio as well as in all our other portfolios together. Significant amount of my personal wealth is invested, running into strong triple digit kind of crore investments into ASK portfolios. And I continue to put more and more as it moves ahead. And I just I want you to be aware that markets in a short term can play truant, but over a period of time, they're gratifying if you're disciplined and right. And we are watchful. If there are areas where we think we made a mistake, where we have slipped up, or where we have not noticed what is to be done, we've been ruthlessly self-critical and weeded out whatever we need to do, and we'll continue to do that if there is any blemish or any gap that comes to our notice. But simply because of some external challenge, which I regard it as a temporary one, ultimately there is a final point I'll make. There is something called reversion to mean. In investing, reversion to mean is a very important idea. If something deserves, a price deserves to be at a certain point, which typically in investing parlance is a congruence of the price with the value, underlying value. But if it is below that value and for a length of time, invariably at some stage it will reverse to the mean, which means it will not only breathe the valuation gap, it typically crosses above it, because rarely when reversing to the mean, valuation gap is filled and prices just stop there. They typically go ahead and overtake, in fact, the values. I think that phase also will come because the portfolio fundamentals are rock solid, like all our portfolios. Other portfolios have all the choices available and they are benefiting from those choices. And we have not compromised on any quality principle of investing. We have not compromised on any fundamental tenets of investing. We have not deviated from buying into fundamentally sound businesses, growing businesses, well governed and well managed businesses, businesses with predictable, durable earnings growth, with a superior quality of the growth. And finally, we have been disciplined to buy them at a price which are cheaper than value. So we are not trying to chase the prices. At the same time, we remain deeply self-critical. If there is something that we have missed out or we have not understood, or we made a gap in our understanding on something, we are far more harsh than some of you probably could be. And therefore, that's what is driving our mindset.
You for a long but very convincing answer, Bharat Bhai. So, investors, I'm reading all your comments, but just like to share one thing. We will try to ask the portfolio level questions first, the underlying stock, and may not be able to ask about dollar, gold, and all. If time permits, we'll ask. Otherwise, we'll avoid. Bharat Bhai, there are 5 questions that come in, and Mr. Ganesh Babu, Sagar Kapadia, Amit Singh, Sanjeev Surana, and Mananas Manami. They've asked your view on Lighthouse Portfolio, and Mr. Sagar Kapadia has asked a straight question: have you invested your money in Lighthouse Portfolio? And Mr. Sanjeev Surana has asked that should I shift from my ISP to Lighthouse? I mean, your thoughts. One, have you invested? What's your view on Lighthouse? And two, should we move from other strategies to Lighthouse? That's the question from 6.
And third, whether I put my own money or not. So that's a simple one to answer. Absolutely yes. And I'm going to put some more money in next few days, and probably I'm going to put a few more crores in a month or two ahead as I get hand on my liquidity as it comes. So it goes into equity. For me, it's a very a very simple decision to make. Whatever surpluses I get, they all go into equities. A large chunk of that basically goes into my portfolios, in which you would have invested. Some of it would go into the investments that I'm permitted to do by my compliance, and which is where my investments would go. So there is a personal portfolio, and there is a significant investment in all my different strategies. I've invested across 6 or 7 strategies of ASK so far. As I mentioned, 3-digit significant number that I put into. I hope I can't be more transparent and candid than that. Uh, as far as view on Lighthouse, you see, it is a very concentrated strategy into areas where we believe there is a greater and great traction lying for a length of time. Ultimately, we must all understand in equity market, the charm, or if I have to put crudely, the sex lies in the growth. Ultimately, without growth, equities never create value. And without growth, actually businesses regress over a period of time. Therefore, as I mentioned, the real charm of equity markets in any part of the world lies with the growth and its direction, its quantum, its sustainability, its predictability, its solidity, and qualitative aspect of growth like return on capital employed and return on equity. Lighthouse portfolio fundamentally is positioned on areas, many of the sectors. When I talked about the budget, I described, and it is fundamentally focused into those sectors because we believe in the coming period of 3 to 5 years at least, far greater growth, far greater than the GDP growth on an average, on a compounding basis, are in these sectors or in these activities. Whether capital goods, whether manufacturing, whether ports, whether airlines, whether tourism and hospitality, whether into energy transition, whether into areas like defense, areas like railway related ecosystem, digitization of this public infrastructure. Many of these opportunities will continue to get larger, more valuable, and bigger. That is something I strongly believe. Therefore, the portfolio doesn't have really any investment in the traditional area like software services. It doesn't have any investment in consumer staples. It doesn't have any investment in the lenders. And it doesn't have today any investment into pharmaceuticals. These areas in most of the other portfolios would be 50, 60, 70% of the portfolios because today also they are among the largest chunk of the indices, largest part of the overall value system, overall value chain. Therefore, this portfolio is a much selectively carved out microcosm out of a macrocosm of a larger opportunity. Therefore, it is concentrated and therefore it is heavy duty focused on areas where we believe the growth is lying. Like they say, and Buffett elucidated once, you need to focus not where the puck, P-U-C-K, puck means where the ball is going, where the ball is. You have to focus where the puck is likely to be. Therefore, in investing, you're not focused on where the ball is. but you are focused on where the ball is likely to go, and therefore you need to position yourself to hit there and be in the right position to be able to score. I believe this portfolio is strongly positioned on what we believe to be strong growth areas for the coming period of a meaningful period of time. Once we believe the opportunities will get materially exhausted, we may change some of those ideas and move to the new ones. And to that extent, this is little more concentrated, less diversified in our general portfolios, but within the concentration of the areas that I mentioned, there are many sectors within which it is invested. I describe almost about dozen of them. Therefore, it is not just centered around a limited 3, 4 areas. It is into a wide spectrum of activities within the country. One final point I'll make. Investing in the past in this country was always bottom up, microscopic, micro level investing because macro structure of the country and economy was always unfavorable. And therefore, markets typically at shorter rise and shorter bull run and longer painful bear run and usually punctuated with violence. If you look at the history of Indian markets for decades, it has been that kind of history. That history has begun to alter, I would say, materially in last 5 years or so. I think in the preceding 5 years, the foundational stones were laid down for the outcome which could have occurred and beginning to get visible in last 5 years. Therefore, in the past, in order to be successful in investing in this country, you had to be a microscopic bottom up investor. Looking at a macro and general picture, you could never make money in Indian markets. Or you would rise and float with the market and drop in sink with the market. That has been the nature. First time in this country, as I mentioned, in the last 10 years, where in the first 5 years, we laid down the foundational stones of many reforms like GST, like digitizing our payment ecosystem and many other reforms that have occurred. And in last 5 years, the outcomes have begun to become more visible and where government has made deep investments in infrastructure and capital capex area to drive the productive capability and capacity of the country, along with the spur to the entrepreneurship and ease of doing business. Therefore, along with the micro, for the first time, a macro theme has emerged where country like India and market like Indian market has become an idea of its own, consequence of its own. Apart from picking and choosing businesses within the market itself. Therefore, if you look at all our portfolios, all along our growth portfolio, which is now 23-year-old history with closer to 20% compounded annual returns over a 23-year period, with an alpha of an incredible 5.5% per annum compounded over 23 years, they basically have thrived all through by being focused on stock selection, by being disciplined on the portfolio construct, by remaining bound to the good rules of investing. First time the macro dimension where Indian market is an opportunity because India is a country and her economy has become strong and predictable and growing. And therefore, Lighthouse is a first portfolio from the house of ASK, which is a combination of both macro top-down approach and the bottom-up micro. And to that extent, it is basically reflecting that reality. Finally, I would say that any any area which is concentrated into some and not all and many other opportunities does carry that concentration risk as much as it carries the benefit of that concentration. So there is always a risk and reward. No investing, even the best investment in the world, is not free from that risk reward perspective. You take so much risk, and you have to balance with what are the likely outcomes, and whether it is an intelligent or logical risk to take, or it is a foolish risk to take. Therefore, any of these concentration has its own source of reward and a source of the risk. Therefore, I would say you should partake of at least three odd portfolios of ASK in order to get sufficient flavor of all the different businesses. So there can be a very strong portfolio like IP. There can be other well diversified portfolios like growth or domestic resurgence portfolio, and there can be specialty portfolios like conviction portfolio, concentrated portfolio like that, or a carved out theme like Lighthouse. And therefore, a meaningful allocation to each is a judicious approach to balance risk and reward.
Sure. Thanks, Bharat. I'm taking three more questions. It all sums up to one. And it says, now that the budget is over, will you recommend us to invest in STP mode or lump sum mode? And it further drills down to maybe Lighthouse and IP, which portfolio to choose. So again, in that sense, difficult to you have to choose between which one to invest first. But the critical question is that they all were waiting for budget as a significant event post the budget. Now, how should one approach in a STP way or a lump sum way to participate in equities?
Well, in my opinion, with the budget, an important event we have seen through. All important points, all important events, we should never take for granted. We should never get overconfident and assume anything, whether it is election outcome, whether it is budget, any other benchmark important event. None of us should ever become overconfident to assume anything, because till something has happened, it has not happened. And therefore, it is important that we have now seen the budgetary exercise. It has confirmed some of the some of the economic priorities and the attention of the government. It has revealed the vision and discipline of the government. It has shown where the path is headed, and therefore, very very clearly, budget is indicating continuity of what we have seen in last 3 to 4 years. When did you see a government where, even in a challenging in the year of election, we not only sought to reduce fiscal deficit, we sought to reduce it by a significant margin from 4.9. We brought down from 5.9, the target was brought down to 5.2, but finally it has been 4.95. And therefore, it requires a courage of conviction for a government in power to be able to take such a step. Because it's not very easy for government sitting in power in the year of election to make such decisions. So it reflects determination and discipline and character of the government decision making. Therefore, I believe, if I have to put it graphically, all floodgates have opened now to see where these floods are going to go. But we should not assume that markets are free from volatility. Markets always will have volatility, and usually they will have more volatility when you least expect it. And usually, when you expect more of it, markets actually tend to usually surprise you at the other way around. Therefore, I would say, on a longer term, I have never been more positive in my 35 years of investing in this country and her stock markets, like I have been for the last several years. and now in particular as well, which means the growth and the quality of growth, and therefore the returns and the strength and the quality of the returns will be unmatched in the future compared to the past. Therefore, what we are seeing is the emergence of the tip of the iceberg, but all of it is to be couched with two important conditions. One, very clearly, that markets are never free from volatility. Time to time, volatility of 5%, 7%, 10% is normal, usual, nothing really to be bothered about. Time to time, but less frequently, there will also be more than volatility, rather, rather a concerning kind of a volatility where 20-25% kind of a change also may occur in the markets. Less frequently, less often, but it can occur. And that again is a part of the market mechanism, market rhythm, market cycles. Rarely, but not so rarely, there can be powerful disruption like 40, 45, 50%, 60% kind of violence also. We saw in the aftermath of COVID, in a matter of 6 weeks, Nifty lost some 38, 39%, mid cap index lost 45%, small cap index lost 52% in a matter of less than 6 weeks. We also saw in 2008-9 the kind of violence where Nifty lost 68% and small cap index lost 82% in a year's time. So violence also can occur. But equally, it shows that when businesses are sound, investments are sound, and with discipline, no matter what may be the worst kind of a crisis and a challenge in the market, the reality of the value will invariably be reflected into the price so long as we are disciplined investors. Therefore, I would say never before is the opportunity of a kind that India offers as the house of businesses, and market is a collection of opportunity of investing. 5 or 6 years back, I wrote an article in Economic Times called "The Golden Decade of India." A lot of people felt it was a bit presumptuous article. Some felt it was a bit ahead of time. Maybe all of that is correct. Today, if I have to write the same article, I would say golden decades of India and not just golden decades. So singular will become plural. I see that kind of opportunity. Therefore, these markets are going to gratify you, going to fulfill you more and more. But we have a duty to remain committed in a disciplined way, in a long term way, in a right way to the markets. Because other than if you don't, markets extract their own prices. Markets are not designed to gladden your heart, as I mentioned. But if you behave and you remain disciplined and in a wise way and remain committed to good businesses at a sensible price, markets invariably reward you over a period of time. That is the opportunity. If you have only one portfolio, say IP or growth or a domestic resurgence portfolio, I would encourage you into buying Lighthouse as a portfolio. If you have bought only Lighthouse portfolio in last 4 months, then I would actually encourage you to buy growth portfolio or maybe Indian entrepreneurial portfolio or even the domestic resurgence portfolio or even conviction portfolio, which is widely diversified but a concentrated portfolio. It's not a portfolio like Lighthouse, which is in a particular areas only. Conviction portfolio is across many sectors, but a concentrated portfolio of about 14, 15 names only. Has done wonderfully well. Therefore, I would suggest based on what you have got today and what you may want to. If you have only Indian entrepreneurial portfolio, and then I would encourage you into put some money into Lighthouse. If you can put surplus out of Lighthouse into Lighthouse, If you can't put additional money, then I would suggest some part of Indian entrepreneurial portfolio can move into Lighthouse, or you can move some part of money from IP or other portfolios that you may have, and additional part money can come from your own and go into Lighthouse. These are the various asset allocation recommendation suggestions I would make in sync with the broader question that that you've raised.
So, any one of you wants to know, I'm hearing what about these funds about, you can reach out to us. I'll have a comment. You can go to our website. You can reach out first if you have an advisor or a RM. Please reach out to them. They'll help you. And in case you're not able to get them, then I think visit our website. Just put your name and address, or maybe type your. I already have received 3 people who have given their name and numbers. My team will reach out today or max by tomorrow, and we'll answer that question. But the sixth question, as type 6.
Nimesh, I just read a question. I thought I'll briefly answer that. Somebody wrote a question that if I'm the first time investor, which is the ASK portfolio would you recommend?
Correct.
If you are a first time investor, I would suggest growth or India Select. That is the portfolio that you want to buy into, growth portfolio really, or domestic resurgence portfolio, or Indian entrepreneurial portfolio. Any one of the 3 is what I would recommend if you are the first time investor with ASK portfolio.
Yeah. And some of you asked that India Select Bharat is not mentioned. For us, India Select and Growth are managed by the same portfolio manager, Sandeep Bansal. Great manager. I think what all of you, some of you asking questions on particular portfolio. So do not worry. In case it doesn't get answered, each of the portfolio manager in the month of August will speak to you 1 hour each and go deeper down into each of the sectors, stock holding, and answer your question. So allow me as many questions I can ask to Bharat Bhai. I will try to ask, but in case it doesn't get highlighted, I assure you from the house of ASK that each portfolio manager will answer every single question of yours, and we will never shy away from answering that. But for India Select and Growth today are the same portfolios. So in case Bharat Bhai has missed talking, he has his own money in the portfolio, and they mean the same for the understanding of. As I said, Bharat, the 5th or 6th person written in different manner, but I'll ask the question is on the impact of short-term STCG and LTCG now on PMS portfolios, and what's your view on that? Because I mean, first earlier the questions were broadly about what the budget view is there, but now the question is there: what will the impact if it were to happen? Will it hurt our returns? And your thoughts on the both the budget STG and long-term capital gains on our PMS portfolios?
No, very clearly. I mean, any raising of the tax is rarely a pleasant exercise, whether deserving or otherwise. I have a view. I feel that equity is a distinguished risk class. The risk dimensions are different, and therefore it deserves a differential tax treatment. Certainly, it is much more distinguished in terms of value creation as well as underlying risk dimensions than real estate. Therefore, harmonizing the 2 assets to a similar taxation is something I have definitely an opinion, or rather a different opinion about, but be it as it may, that is the reality of what has been done. There are also some of the inequities, like some of the structures, like pools, like mutual fund, where underlying portfolio may be going through a lot of relentless buying and selling, but a pool doesn't pay the tax. It is the individual who pays the tax whenever he or she redeems. Um, to that extent, it is unfair and iniquitous. I think, like many other aberrations in the system, have been sorted out over time. I'm sure at some stage this also will get sorted out, where the pools will become the vehicles where tax will be aggregated, and they'll become distribution vehicles where tax also will be passed through to the eventual investor, and therefore there'll be a complete alignment of all the structures, because regulator or fiscal interest can never be to favor one structure over the other. It is underlying instrument in the modality of the investment, which is important. And therefore, unfortunately, some of these oddities have remained. Some have been sorted out over last 2, 3 years. This one oddity remains. Raising of the long-term capital gain stakes is a relatively not that I'm happy that it has been raised, but a relatively more solvable issue or relatively less challenging one. On the other end, short-term takes from 15 to 20 certainly is a reasonably large takes, is a material one. Usually, if you see our portfolios, our 90% or 95% of the gains tend to be in the long term. And rarely a double digit percentage of gains in a year would come from a short term. Barring a couple of years, I don't recollect when short term gains in the portfolio, in any portfolio, would be more than double digit in any particular year. More than 90% typically will be long term. Also, our churn rate itself is lower, where we move from one name to another often enough doesn't happen. Therefore, relatively, generation of capital gains is lower. And within the capital gains, usually it is in favor of preponderantly in favor of long term. That long term takes at 12.5 is relatively mitigatable one, I feel. And I mentioned by design our portfolios are long term and less churn oriented, and therefore I think will be able to deal with this issue.
Sure. A question has come on Asian Paints about the competition with JSW and all. Your thoughts, especially because you've been holding Asian Paints for long, so they want to know your thoughts on, I forgot the name of the person, I'll just tell you, but their views on Asian Paints for you, in the industry and Asian Paints in particular.
In some portfolios, we have exited Asian Paints quite some time back. But in our couple of portfolios, Asian Paints still remains kind of a little toned down weight, but it is still there. It's an outstanding business built over decades with great passion and with great capability. One of the biggest value creators in the Indian stock markets for a long period of time. From the character of the business, character of management, strength of the long term results that it is built, the value it has created, there is nothing not to like about Asian Paints. I mean, it is a fantastic business to be in. And the issue about competition from Grasim is a reality. We as yet do not know how the competitive dynamics will play out. Whether Grasim will look at, say, for example, Ambuja Cement, after it was acquired by Adani Group, they've been on record saying that they do not want to upset the apple cart of the industry. They do not want to run through competition in such a way where not only you injure others, the competition, but you injure yourself as well. And therefore, right from the time of takeover of Ambuja, the Adani Group is played by the competitive dynamics and the competitive rules. Their competition has never been on the price. It is on quality of the product, quality of the service, and the kind of internal cost management in order to improve the performance of the business. How it will play out in paints area by Grasim, we'll get to know more. We have just begun to see advertisements of Opus from Grasim now beginning to look more visible. We are hearing that some amount of competitive dynamics also are in terms of price actions are happening, but not in a very large way as yet. The time will say, time will show how it will play out. I think market is very large and it's a growing market. 3 lakh crore market in a country like India for paints is not a particularly huge kind of industry. There is scope for it to be much more as we build more houses, as we get towards better and distinguished paints, as we protect our industrial manufacturing assets with specialty paints, and or we protect the outer walls of the buildings and commercial buildings with the specialty paints and other solutions. As that happens, I think opportunity is still significant, but exactly how the grassing competition in terms of price behavior, high competition, or sensible, intelligent competition, those still have not emerged. It is a bit early to say. Prices, of course, reflect the fear and have dropped and have remained under check. Whether actual market conditions and business conditions will be as much as the fear reflect, I think it is a bit early to make an opinion about. But clearly, at this juncture, uh, there is that looming large factor of that heightened competition from a strong player like Ultratech into paints area. We are watching.
Sure. Maybe one more question on a stock, which is for a group, since we hold Bajaj Finance and FinServ. Ranjan, Subudhi, and one more other person has asked, your view on Bajaj Finance keep going down. So what's your take on Bajaj Finance and Bajaj FinServ both?
Simple answer on Bajaj Finance. I wish I knew. I'm at a bit of a loss to understand why Bajaj Finance, after being phenomenal value creator for last 13 years, in last 2 years out of the 15 years of Bajaj Finance, the first 13 years have been phenomenal. Actually, first 12 and a half years have been phenomenal. Last 2.5 years have been incredibly difficult in terms of stock price as far as that is concerned. Just to put in perspective, 2.5 years back, Bajaj Finance price was at about 5,400. Today it is at some 66, 6,700, something like that. So it has barely moved up. I mean, over 2.5 years, it has inched up only about 20 to 23%. Therefore, that's basically single digit compounding. And in 2022, it actually made a negative return in that year. But I can also point out what is at work in terms of the quality of what is going on and the strength of the business which is being built. If you look at last 4 quarters, they've been among the strongest ever quarters in the history of Bajaj Finance in terms of return on asset, return on equity, in terms of the rate of growth of the asset book, in terms of solid diversity of various different lending solutions. Today, Bajaj Finance offers 38 different lending arena, different balance sheets and P&L for those 38 lending verticals, whether rural B2C or B2B, whether it is urban B2B, urban B2C, consumer loans, MSME loans, specialty professional loans, specialty need like travel or expensive surgery related loans, various kinds of verticals that Bajaj Finance today, and the diversity of the solutions has never been more than today, including foray into the gold loans. So truly it is constantly, as it has grown at a rapid pace. Even in the last quarter, if you see, the asset book grew 31%. The net interest income grew 26%. 26%. That is slight compression on the net interest income because of the rise on the cost of the funds, while yields take some time to be raised, and therefore in the interim period which may last up to say September 24, 2 more months, where yield or NIMs may compress a bit. But from October onwards, we'll once again see their yields or margins on the lending rising. There was a small operating leverage, though not much. Therefore, profit before provisions have grown at the rate of 28%. It is the provisions which have gone up sharply by 68% compared to last year, and therefore pre-tax profits have grown only 16%, one of the lowest for Bajaj Finance in a long time. That again, you see there, the credit cost provision they made is a prudent own volition kind of credit cost they have provided. It is not as if those assets have turned bad, but this is a period during election time and the heat wave. All of the lenders have witnessed a differential experience in terms of the collection yield, and therefore Bajaj Finance also has experienced that collection yield related delays. If you see actual numbers in terms of default, it is continuing to be in a similar territory like in the past. And among the most qualitatively soundest numbers. But because the yield, the collection efficiency numbers have declined a bit, is a prudent lender on their own, they've chosen to provide upfront much larger amount than really warranted. In all probability, we may see reversal of some of these provisions actually going ahead as the yields are collection numbers beginning to normalize. Already in July, it is normalizing, and therefore there is a good chance we'll see reversal. Therefore, this is a business which last 4 quarters have been the best ever in terms of return on asset, return on equity, in terms of the quality of growth, in terms of the sheer diversity of solutions, and therefore risk control. And yet, surprisingly, the price has barely moved up in 2.5 years. Just about, if you had 2.5 years back, Bajaj Finance, it has gone up only by 6-7% per annum in this particular period. So it is truly baffling. In valuation terms, today Bajaj Finance has actually become much cheaper than many other smaller lenders on the NBFC side, or cheaper than even larger lenders in the banks. Almost all the banks have half the return on equity of Bajaj Finance. They have no more than two-thirds of the earnings growth rate of Bajaj Finance. And their valuations are adjusted for this reality, are actually higher than Bajaj Finance. Now, this is an oddity I have never seen in 15 years in the first 12.5 years. But in last 2.5 years, we are witnessing that oddity. Honestly, I don't have a very good answer why it is prevailing, except that maybe choices have widened. Earlier, PSU banks were a no-no. Private banks also were a no-no. They came out of very bad credit cost trouble, and from there they recovered, and therefore they experienced a huge bounce. Bajaj Finance, even during that hump on the COVID period, did not experience any huge amount of credit cost, and it provided well ahead of what was really required. Therefore, for Bajaj Finance, it was business as usual, and therefore the relative bounce that you saw in Bajaj Finance has been lower. So I suspect some amount of money people have chased into other lenders, even though qualitatively in growth terms, in return on equity, in return on asset, they are materially inferior compared to Bajaj Finance. But that all say, price is price. A price of 2.5 years is a reality. It doesn't give us a wee bit comfort that Bajaj Finance is why the price is not reflecting the reality. I'll give one another comparison. IREDA, public sector firm in the renewable energy which has come. Few months back, the IPO came. It's a relatively small firm. Asset book is about 75,000 crore right now. Return on equity is about 18%. Return on asset is roughly about 2.5%. While Bajaj Finance has a 5.2, 5.3% return on asset, actually the March quarter had a highest ever of 5.45% ROA and return on equity on a standalone basis of 32%. So it has doubled roughly doubled the ROA, double the return on equity. Growth rates are higher for IREDA on a smaller base, but profit growth for Bajaj Finance is similar or higher than IREDA. IREDA quotes at 6.6 times price to book on 2026. Bajaj Finance quotes at 3.5 for 2026. Now, I've never seen irony or oddity of this kind ever before. Many of the banks, whether on a private or one or two of them on public sector side, adjusted for the ROE, for the ROA and the growth rate. Some of them, two, three of them are actually adjusted for that first time are slightly more expensive than Bajaj Finance. While traditionally Bajaj Finance would have been two times, three times more expensive than them. So this phenomenon also we are seeing for the first time. My mind is not at a rest because on one end, fundamental performance of the business is phenomenal and very sound, one of the best ever in their history, one of the best value creators in the Indian stock market history for 13 years out of the last 15 years. But last 2.5 year behavior of the price is puzzling. Maybe people have more choices within banks, within NBFCs, or other than banks and NBFC, and therefore Bajaj Finance has become darling to be hated or to be disliked. God knows what is going on. All I can say is valuations are more compelling than ever before. Character and quality of the business is rock solid as ever before. And usually, market dislike for a prolonged period in a good business, assuming that everything is good like I have described and we have not got it wrong, usually is a recipe for reversion to mean with vengeance. Whether that point is now or a month later or 3 months later or 6 months later or never, time will tell. I hope I am right and not wrong. But it is something receiving huge amount of attention from my team members and myself, and I don't have beyond what I've answered much better answer to give.
Uh, I think, Bharat, with you, we don't realize. I just looked at the time. It's almost 5 o'clock. So it's been 1.5 hours since we are been talking. What we'll do, I have noted down other questions. 5 people have written down their mobile numbers as well. So my team or myself will call and reach out to you. And as I shared with each one of you, there are some questions which are unanswered yet on certain GDF portfolios, or somebody has put question on the EOF portfolios. As I say, our fund managers, each of them will spend 1 hour in the month of August only speaking about that portfolio, and we will address it then. Maybe I'll request Bharat Bhai if he wants to just close with his thoughts, and we can close this call today with a closing comment if you want to. Otherwise, we can close it at the end.
Sure, I'll take a minute. Budget is confirmed, reaffirmed the financial economic tone of this country, not just of the government, and affirmed it with great amount of stamp of authority on that. That is a huge, huge comfort giver. Number two, in my opinion, the growth rate for this country, GDP, it's her businesses, and therefore their profits, their cash flows, in my opinion, will be superior than at any other time in the past. Compared to India's own history, compared to other markets and other places, other economies in the world. Third series of reforms has built structural strength and not a tactical capability in the country. Therefore, India, apart from always being a great bottom up story, has also for the first time emerged as a strong top down story as well. And therefore, it is the great unison of both macro and micro today, which gives us a huge amount to thrive in, because traditionally our strength has been micro bottom up stock picking with a great deal of discipline and panache. The macro factor aids further strength and drive to attain equal, if not far superior outcomes than in the past. Fourthly, markets are never, even when everything is comfortable, markets find a reason to be unhappy. And where there may be 20 reasons to be unhappy, and markets still may find solace. That is the nature of market. Mr. Market is weird in the short run, or it may look weird in the short run to a lot of people, but Mr. Market is very rational and logical over long run. Therefore, time to time, even when there is all happiness around, Mr. Market can find unhappiness. Even when there are plenty of reasons to be worried, Mr. Market can find reasons to be happy. That is Mr. Market for you. Therefore, volatility is given. Occasional sharper reactions of the market also would occur time to time. Not so often, but once in maybe 10 years, 15 years, 20 years, violence also can occur, like we have seen. Only good part is endogenous, exogenous events like COVID, nobody can control. But endogenous events like banks and NBFCs finding asset quality stress, businesses' balance sheet going out of the window, capital efficiency of several businesses struggling. And therefore, we saw 2014 to 2019 corporate earnings grew only 7%. But 2019 to 24, the corporate earnings have grown at 14%, double the rate of the first 5 years. And I would dare say there is a very, very good chance that the numbers going ahead for the next 5 years or next 10 years will be, in all probability, higher than the last 5 years of 14%. Is a very good probability on a larger base. Therefore, I think if we are able to keep our minds cool, not get worried by market volatility or skirmishes, at times violence, but structurally violence probability is materially reduced, except exogenous events like COVID can cause a violence of 50, 60, 40% types. Otherwise, I really see no such possibility on the horizon. There can be corrections, there can be rebucks, there can be normal volatility, but not violence really. Therefore, these are beautiful markets to play. If you're a long-term investor, and opportunities are plenty, choices they widen. In our market, stock market, choices have become much more than what they were 10 years back. And therefore, truly risk is reduced and return capability has gone up. And therefore, these are beautiful markets to play. Valuations are no longer as cheap as they were in 2022 when markets were struggling. Markets barely inched up in that year, though our portfolios did much worse in that year, registered negative returns. 2023 market went up sharply, nicely, but valuations in many stocks were still very favorable. Today, I will say valuations are reasonable. They are not cheap like they were in 2022, certainly not as cheap in 2021, but they are not off putting ones either. They are in a fair territory. That's a beautiful game to play. There can always be pockets of excesses in markets and pockets which deserve to be corrected. But market is a great leveler. It's a self-correcting, ferocious machine. So it will adjust and readjust any out of line valuations. But otherwise, it's a great market to play.
Vivek, on that note, Bharat, we thank you for your time again, and investors join us back again with the quarterly update in the month of October. We'll give you, and the recording of this session will be sent on an email to each one of you, and look forward to connect again in the month of October. Thank you, Bharat.
Thank you.
Thanks for your time.
Thank you. Bye. Bye, everybody.
Bye.